You're not supposed to turn $500 into freedom money. That's what people say, right? 500 bucks barely fills your gas tank, let alone builds a life you don't have to escape from. But what if that same $500 could one day pay you $4,000 a month? Forever, without you having to work for it again? That's not fantasy, it's math. And it's the quiet power of dividend growth investing. The strategy nobody brags about on social media because it's slow, patient, and boring. Until it isn't. Until one day your portfolio starts sending you paychecks while you're asleep. Wealth doesn't come from winning trades or chasing crypto pumps. It comes from assets that pay you back over and over for decades. That's what dividend ETFs do. They take your tiny seed of money and build you a tree that keeps dropping fruit every single quarter. So, let's talk about how a small start, $500, can snowball into a machine that spits out $4,000 in passive income every month. Not maybe, not if you get lucky. Predictably, mathematically, step by step. It begins with mindset. Most people think investing means buying a stock and hoping it goes up. But dividend growth investors think differently. We buy businesses that share their profits with us, companies that have done it for decades, through recessions, pandemics, wars, still paying, still growing. Now here's what makes dividend ETFs so genius for beginners. They package dozens of those companies into one basket. So instead of guessing which stock is the next winner, you own all the proven ones, the legends, the cash printing machines. That's what funds like SCHD and VYM are built for. Imagine it this way. You put $500 into SCHD. That's the Schwab US Dividend Equity ETF. Inside it, you instantly own slices of Coca-Cola, Pepsi, Home Depot, Pfizer, Texas Instruments, real profitable businesses that pay shareholders cash every 3 months. And they don't just pay, they raise those payments every year. It doesn't feel exciting in the beginning. You might get your first dividend check for $5. You'll laugh. It's a coffee, right? But then you reinvest it, and the next time, that check is $6, then 8, then 12. Slowly and visibly, the snowball starts rolling. Here's where things get fun. Let's say you add $400 every month. That's not a fantasy number. That's Netflix, Starbucks, and Uber Eats combined. You redirect your spending, and suddenly your money starts working harder than you do. By the end of year one, your total contributions, about $5,000, have already grown to roughly $5,400, assuming average market returns. Nothing wild yet. But that small foundation, it's a time bomb of compounding. Fast forward 5 years, still just $400 a month. You've put in $25,000. With reinvested dividends and growth, you're sitting around $33,000. And those dividends now pay you about $1,200 a year. $100 a month. That's your phone bill covered. From investments. No selling, no trading, just cash flowing in because you own real businesses that keep making money. Now here's the twist most people miss. The longer you do this, the less you contribute to the growth, because your portfolio starts compounding on its own. At 10 years with the same habit, $400 monthly, you're looking at roughly $70,000 to $75,000. And now your dividends? Around $2,800 a year, about $230 per month. So that's groceries. That's small freedom. But the moment you cross the 10-year mark, compounding begins to sprint, because dividends aren't static and they grow. SCHD, for example, has increased its dividend payouts roughly 10 to 12% annually. That means your income is climbing, even if you never add another dollar. By year 15, your portfolio hovers around $150,000. Dividends? Close to $6,000 per year. That's $500 every month, just for owning shares. And by 20 years, assuming an 8% annualized return and steady reinvestment, that same plan builds a portfolio north of $300,000. Your dividends now? Around $12,000 a year, $1,000 a month. Now imagine at that point, you start increasing your monthly investment from $400 to $800. The numbers start bending in your favor. The curve steepens. At that pace, within a few more years, you hit the magic zone. $1 million portfolio paying roughly 4% in annual dividends. That's $40,000 a year, or $3,300 a month. Push it a bit further, and boom, you're staring at $4,000 a month in pure recurring income. The crazy part? You didn't have to beat the market. You didn't have to pick the next Tesla. You just stayed consistent, bought broad market dividend ETFs, reinvested, and let time handle the heavy lifting. See, that's what the rich quietly understand. They don't chase money. They position it. They build systems where money reproduces itself, and the most beginner-friendly version of that system is dividend growth investing. It's not sexy in the beginning. It's like watching paint dry while your friends brag about day trading wins. But 10 years later, when their hot stocks crash and burn, your portfolio is still sending you checks like clockwork. Because this isn't a sprint, it's an ownership plan. You're buying small slices of cash-flowing empires, and those empires reward patience. The average dividend ETF pays 3 to 4% right now. But that's just the starting yield. The growth rate of those dividends is where the real compounding happens. For instance, if you earn $1,000 in dividends this year and the payout grows by 10% annually, in 10 years, that $1,000 becomes $2,600 a year without adding new money. That's 160% more income from the same shares. Combine that with reinvested compounding, and suddenly your income graph starts bending upward like a hockey stick. Now let's talk about where those numbers come from. Because it's not magic, it's cash flow. Companies inside SCHD and VYM have real profits. When they pay dividends, they're distributing part of those profits to shareholders. You, as a holder of these ETFs, own small pieces of hundreds of companies doing exactly that. VYM, for example, leans towards stable, higher-yield names. Think big banks, telecoms, oil companies, while SCHD focuses on consistency and growth. Pepsi, Texas Instruments, Broadcom, Home Depot one gives you steady payouts. The other gives you rising ones. Together, they form a perfect balance for long-term compounding. Here's a visualization. Picture two plants growing in your garden. VYM is the strong, thick one that grows slowly but produces fruit early. SCHD is a smaller one that takes a bit longer but ends up towering, with branches full of fruit that multiply each season. Plant both, water them consistently, and in 20 years, you've got a forest. People overcomplicate investing. They think you need genius timing or secret information. You don't. You just need time, patience, and discipline. $500. That's it. You can start with that. It's not about how much you invest. It's about how long you let your investments breathe. That's the trap everyone falls into. They want quick money, but the quick money is fragile. The kind that disappears the moment you blink. Slow money, that's the kind that sticks around forever. If you look at the math, investing $500 up front and $400 a month for 20 years at 8% average returns turns into roughly $236,000. Keep reinvesting, keep compounding, and your dividends will start generating thousands per year, growing faster each time at an extra 5 years, and that $236,000 becomes $375,000. Add 10 years and it's $647,000. Time is the cheat code nobody uses. And the best part? The system doesn't care where you start. Whether you've got $50 or $500, the math works the same, just on different timelines. That's the first shift. Seeing your money not as something to spend, but something to multiply. Because the real goal isn't saving. It's ownership. You don't want to store money. You want to own the things that make it. And when you understand that, that's when $500 stops being small. It becomes your first employee, your first worker in a business you don't have to manage. And if you stay consistent, that worker hires more workers. Your money starts recruiting money. And that's when compounding stops feeling like theory and starts feeling like freedom. It sounds almost too good to be true at first, that a handful of dollars dropped into an ETF each month could turn into something that replaces a full-time income. But the math never lies and compounding never sleeps. Let's play the long game together for a second. Imagine you start the same way we talked about. $500 up front, $400 each month after that. You're not chasing the market. You're just letting the automatic purchase run every month like clockwork. That single habit is where everything changes because time is the multiplier most people underestimate. In the first few years, progress feels painfully slow. You check your account and see a few extra dollars, maybe a $20 quarterly dividend. But underneath that boredom, the real work is happening. The quiet cycle of reinvestment. Every dividend buys more shares, and those shares start paying their own dividends. The loop tightens. The machine starts to hum. Now let's stretch it out. 10 years in, you're seeing something that finally feels tangible. Your portfolio hovers around the mid-five figures. The dividends that used to buy you a sandwich now cover a car payment. You start to understand what financial gravity feels like. Your portfolio is pulling in money without you doing a thing. By year 15, that number doubles. The cash flow doubles too. And here's where most people realize the game has flipped. The money you make from the market is larger than what you're putting into it. Every month, your investments are working overtime, and you're just supervising. This is when you can start adjusting the dials. Maybe you bump your monthly contribution a little. Maybe you let the snowball roll on its own. With funds like SCHD and VYM, those payouts keep climbing. 10% annual growth in dividends doesn't sound like much, but over a decade, it means your income more than doubles. It's a quiet revolution happening inside your account. Picture this, a chart on the screen showing your dividends over time. The early years are a flat crawl, then somewhere around year 10, the line bends upward. The compounding curve finally wakes up. By year 20, it's a steep climb. That's when your portfolio hits seven figures. At a 4% yield, that's $40,000 a year, $3,300 a month. Push it a few more years, and the number touches $4,000 monthly. The beautiful part? You didn't have to gamble to get there. You didn't even have to be perfect. The only skill required was consistency. And consistency is underrated. Because while everyone's out there looking for the next shortcut, the crypto that 10 times or the meme stock that can't lose, you're over here quietly buying assets that pay you cash just for holding them. It's not flashy, but it's real. Let's break down what those monthly payouts actually mean in life terms. $4,000 a month isn't just numbers on a screen. That's your rent or mortgage. That's groceries, utilities, and a few luxuries. That's the difference between working because you want to and working because you have to. And the craziest thing is, the strategy is so simple that most people overlook it. You pick quality dividend ETFs, you reinvest everything, and you let time do what time does best. Multiply SCHD gives you exposure to strong, cash-rich American companies that keep growing their dividends. VYM gives you a stable base of higher yielders that keep your income flowing mix in a small slice of JEPI if you like extra monthly cash flow, and suddenly your portfolio feels like a balanced living organism. Part growth, part stability, part income. Now here's where things get philosophical. Most people spend decades trading hours for dollars. Dividend growth investing flips that equation. You start trading dollars for hours, buying back your own time, one ETF share at a time. It doesn't happen overnight, but the day that your investments pay your rent, the game's over, you've won. And the truth is, you don't need to be rich to get started. You just need to start early, because compounding rewards time more than it rewards size. $500 at 20 years old grows into more than $5,000 at 40. But $500 at 40 barely scratches $1,000 by 60. The earlier you plant, the crazier the harvest gets. Now let's talk about the psychology of this. The hardest part of this journey isn't market crashes, it's boredom. Watching a dividend portfolio grow is like watching a tree. Nothing seems to change until one day it's towering over your house. The secret is to stay the course when it feels slow, because the boring years are when the roots are forming. When the market drops, everyone panics. Dividend investors smile because those same ETFs now pay higher yields and let you buy more shares for the same money. Every downturn is a sale on future income. That's why some of the wealthiest investors secretly hope for bear markets. They know they're just accumulating more cash flow for cheaper. So you hold. You buy through the dips. You reinvest those dividends automatically. And one morning, you wake up, log in, and realize your portfolio made more money in dividends that month than you used to make at your first job. That's when it clicks. You didn't just invest money, you built an engine. One that never sleeps, never complains, and never asks for a raise. And the best part? You can design this engine however you want. Want more growth? Tilt toward S, CHD, and VIG. Want more yield now? Add a dose of JEPI or VYM. Want to balance the two? Go half and half. There's no perfect mix, just the one you can stick with. By the time you're 15 or 20 years in, the math starts doing backflips. Even if you stopped contributing altogether, your dividends would keep compounding. At that point, your portfolio is generating its own fuel. Reinvested cash that keeps buying more income. That's the moment compounding goes from theory to autopilot. If you've ever wondered what financial freedom feels like, it's that. It's the calm of knowing your bills are paid before you even get out of bed. And all of it, every dollar of it, started with $500, a small seed. The kind of number most people dismiss as too small to matter, but the difference between $500 that's spent and $500 that's invested isn't $500. It's a lifetime. Because the truth is, you don't need a massive salary or insider access to the market. You just need patience and a plan. That's the Dividend blueprint. Start small, add consistently, reinvest relentlessly, and let time do what time always does. Reward the ones who don't quit. At first, the money trickles in so slowly that it almost feels like a joke. A few dollars here, a small deposit there. Nothing that makes your heart race. But one day, something shifts. The numbers stop looking small. The dividends you used to ignore are now buying full shares every quarter. The curve you once thought was flat suddenly starts bending upward, and you realize compounding doesn't whisper. It roars, just very quietly at first. This is the moment most people never reach because they stop too early. They get bored or distracted or panic when the market dips. But if you hang on, the exponential part of the curve starts to reveal itself. The snowball doesn't just roll now, it accelerates. Picture it. You're 20 years into your journey, and your portfolio is sitting comfortably north of $1 million. You've built this machine slowly, piece by piece, one ETF purchase at a time. SCHD has done its job, delivering steady growth and raising its dividends almost every year. VYM's steady yield has kept your income solid even through rocky markets. The mix of the two means you've captured both rising payouts and stable cash flow, and now that balance is paying off. At a 4% yield, you're earning about $40,000 a year in dividends. That's $3,300 every month, deposited like clockwork. It's no longer a theory, it's rent, groceries, travel, and peace of mind, all covered by the same system you built with a single $500 deposit years ago. Add just a few more years of patience, and that number crosses $48,000. $4,000 every month. The number that once felt laughably out of reach now lands in your account automatically. Quarter after quarter, it's not luck. It's not genius. It's just time and discipline playing out exactly as the math said it would. Now imagine what that freedom actually feels like. You wake up on a Monday morning and realize your portfolio earned more in dividends over the weekend than you used to earn working an entire week. The pressure that used to sit on your shoulders, gone. The bills, the deadlines, the "I can't take a day off" mindset, gone. Because money is no longer something you chase, it's something that quietly arrives. That's what makes dividend investing so powerful. It doesn't change your life in a flash. It rewrites it line by line until one day you look back and realize you're living in a completely different story. You went from consumer to owner, from paycheck to cash flow, from stress to stability. And the path was never complicated. It was just about showing up month after month, no matter what the headline said. Because the truth is, the market rewards those who stay. Every crash, every correction, every worst year ever is just another sale on your future income. Those reinvested dividends you pick up during the hard times become your biggest paychecks later. The hardest part is trusting the process when it's quiet. But if you stay the course, you realize something else. Your portfolio becomes your business partner. You've built an invisible company that runs 24 hours a day, paying you a steady salary for the rest of your life. And all you had to do was let it grow. Here's the secret most investors never talk about. The goal isn't to get rich, it's to get free. When your dividends cover your living costs, your time becomes your own. You can choose to keep working, travel, build something new, or do absolutely nothing. You've decoupled your income from your labor, and that's the moment you cross the invisible line between surviving and living. This is what the $500 to $4,000 journey really represents. Not just numbers, but transformation. A shift from instant gratification to delayed exponential reward. A shift from fear of losing money to confidence in building wealth. Because once you've seen compounding work in real life, you stop looking for shortcuts. You realize time was the shortcut all along. So if you're just starting, don't worry about the small numbers. Don't worry about whether you can contribute $100 or $400 each month. Worry about consistency. The first habit you build is worth more than any stock pick. Set up that automatic investment. Pick your ETFs, SCHD, VYM, maybe a small slice of JEPI for monthly income, and let them do their job. Reinvest everything. Watch it grow slowly, then suddenly. And 20 years from now, when that $500 seed has turned into a money tree, feeding you $4,000 a month, you'll realize something profound. Wealth isn't created in moments. It's built in the spaces between them. Quietly, patiently, compound by compound. So take the first step today. Don't overthink it. Open the account, buy your first share, and start the clock. Because every month you wait is one less dividend payment your future self could have earned. Your freedom is hiding inside the math. You just have to give it enough time to reveal itself. And when that day comes, when your money finally makes more money than you do, you'll understand what all of this was about. It was never just about the $4,000 a month. It was about the feeling of never needing to ask. If that's the kind of freedom you want, start today. Take that first $500, put it to work, and never stop feeding the snowball. And hey, if this opened your eyes to what's really possible, hit that subscribe button. Drop a like to help the algorithm push this to more future investors, and leave a comment below telling me how much you're starting with. Let's grow your income and your freedom together.